we're going to take a quick look and just really discuss in general the difference between the accounting basis for property, plant, and equipment versus the tax basis. So we've covered how we record amortization expense. That is the accounting basis. So for accounting, we record that expense each year based on one of the three methods that we looked at. So straight line, units of production, or double declining. But when it comes to tax, there's actually a set way that every company needs to amortize their assets. So when you complete a tax return, you reverse the accounting expense or pretend that you didn't book that expense, and instead you book this amortization, but for tax. And this is actually called the capital cost allowance each year. So for accounting, we call it amortization expense. For tax, we call it the capital cost allowance. But again, it's still just moving a portion of that cost of the asset to the expense each year, just a different name. For tax basis, you actually use specified rates that are given by CRA for the different classes of asset. So for example, vehicles, they fall into class 10 for tax purposes, and that is at a set rate of 30%. So regardless of how you do your amortization for accounting, when you have a vehicle for tax, it's that class 10 at 30%. Equipment falls under class 8, which CRA has set at 20%. So you would just use the rates that you have to that are set and specified by CRA. The calculation method for tax basis is similar to double declining. So you're using that set rate and you're going by the book value or the carrying value for that tax basis. So that's all we're going to go through on this. You don't need to know the details of it right now. You just need to know that they exist or there's differences between the two. So when you get to a tax return for a company that has PP&E, you reverse the accounting and then you do this tax part instead. Okay, next we are going to look at what happens if you have a change in some sort of estimate or a change needed for your amortization calculation. And you can see here the two reasons that you may need to change the way you're calculating amortization. The first one is that you have a change in an accounting estimate. And here we know the two methods or the two things that we estimate when it comes to amortization. The first one is the estimated useful life. So when we buy the asset, we estimate how long we think it's going to last, and we could use that. So that could be in years or in units of production. And then the second thing that we estimate is the residual value. So we have that estimate based on our history or experience, what we think it's going to be worth at the end of its useful life. But these are estimates. So we make that estimate at the start of the useful life based on what we know at that point. But as years go on and we start using the asset up, these estimates they could change. So we could have something that goes on or get some sort of new piece of information, and it changes how much we think the useful life will be or how much we think we're going to get at the end. So if we have these amounts that change, we basically stop where we're at and we would recalculate our new amortization based on these new estimates that we have. So this is called prospective treatment because we're not going back and fixing anything that's already done. We're just updating our calculation on a go-forward basis. If you had, or the other reason that you might need to change your amortization is if you have the addition of a betterment. So remember, we talked about this. If you have some sort of new cost that makes your asset better, so more efficient, extends the useful life, all of those things. If it makes it better, we capitalize it or add it to the cost of the asset. So therefore, we need to now amortize the betterment as well. So we also need to amortize the betterment over the remaining useful life now. So if you have this betterment 2 years into the 4-year useful life, well, now you would amortize this over those remaining 2 years. So the next slide that I'm going to show you looks wild, and there's a lot of ins and outs, but it's actually not as complicated as it looks. So don't be too freaked out. So these are these really long formulas. So if we were using the straight line method, basically it just is telling you we know the cost minus accumulated amortization equals book value. So you look at, where am I at right now? That's the current book value that you have. So whatever it originally cost, plus any amortization you've recorded to that point in time. So that's your book value. If you had a betterment, you would just add that in there. So it's essentially getting you a new cost or a new amortizable cost that you need to amortize. So this part, the cost minus accumulated plus the betterment, you really just consider that your new cost that you're going to be looking at. Then you would use this new residual value. So if that changes, you would subtract subtract that. If it didn't change, you would just use whatever the original one you had was. And then you would now amortize this or divide this by your estimated remaining useful life. So you're likely only going to have 1, 2, or 3. One of those things would change. So you're basically just going to slot in which piece of information you need. Same idea when it comes to units of production. This is saying, what is my book value at this point? If you had a betterment, you would add that to the cost. You'd then subtract your new residual. So this is just cost minus residual divided by now the remaining useful life in units of production. So it looks like a lot, but it's just adding new information in. Revise double declining, well, we take 1 divided by the estimated remaining useful life. That would give us our straight line rate. Then we times it by 2. And here, we're multiplying this by the carrying value, but in this case, or the book value, in this case, if you had a betterment, you would need to add that because you would have booked that into your T account. So it's the original cost plus the betterment minus any accumulated you've booked up to that point. So again, as I said, it looks like a lot, but it's actually not that complicated. Here's what you need to think. Think, what's my current book value? So what is your cost minus what you've booked in accumulated amortization? Use that as your cost, but then if you have a betterment in the question, you would add that, and that gets you to the cost. Then you basically just use your residual value in the same way, times it or divide by the estimated useful life. And same thing here. Your carrying value, you would just add that betterment. So we'll go through an example, and I think hopefully it will make you feel a little better that this isn't quite as wild. So we'll look at S10-10, which is on page 583. So it says, assume the Gold Eyes Baseball Club paid $60,000 for a hot dog stand with a 10-year useful life and no residual value. After using the hot dog stand for 4 years, the club determines that the asset will remain useful for only 2 more years. So it says, record the amortization expense on the hot dog stand for year 5 on December 31st. the company uses the straight line method for amortizing the assets. So for those first 4 years, we use the original estimates that we had. So first step here, we say, well, the original straight line amortization was based on our cost minus the residual value divided by our estimated useful life. And this is what we originally thought. So the cost, that was $60,000. Residual value was estimated at 0, and we thought it was going to last 10 years. So if we do the math, that was $6,000 per year based on that original. So each year we would have booked amortization of $6,000. So it said that after using it for 4 years, that means we booked 4 years worth of amortization. So we can figure out that our accumulated amortization at the end of year 4 is equal to our $6,000 per year times by 4 years. So at that point, it's sitting at $24,000. That's our accumulated amortization. So our book value at the end of year 4 is equal to our cost minus accumulated. So $60,000 minus $24,000, and that equals $36,000. So that's our current book value. So basically, when you get to this point, or when you have a change in estimate, that's where you start. You figure that out. Where am I at right now? And then you use that information and you adjust for any changes that you had. So if we're using this straight line, we could look at this first formula at the top there. So we've figured out our cost minus book value. In this case, we don't have a betterment, so we don't need to worry about that. Our new residual value, well, it doesn't say that that changed. It's just our useful life. So this is still 0. So basically, we just say, well, what is our book value? And divide that by this new estimated remaining life, because that is what's changed. So we are sitting at this book value of $36,000. So our new straight line amortization expense, we've got the $36,000, that's our book value. Residual is still 0, and we had no betterment, so we add 0, subtract 0. But now we need to use the new estimated useful life, and it said we think it will remain useful for 2 more years. So now we divide this by 2, and we're going to be booking $18,000 per year. So in the end, we got these first 4 years, and we're going to get 2 more. So only 6 years compared to those 10 that we originally thought. So in year 5, it asks us to record the entry. We would debit amortization expense for $18,000 and credit accumulated amortization. They probably put the hot dog stand in equipment. So that would be our entry in year 5 as well as in year 6. So these formulas on the previous slide, they look pretty crazy, but they're really not that bad. You just have to first figure out where are you at and then adjust for your changes in estimates from that.